When investors hear the name London Stock Exchange Group, they picture a legacy institution tied to the daily ebb and flow of stock trades. That name masks its current reality. The company traces its origins to 1698 at Jonathan's Coffee House, where John Castaigne began issuing lists of stock and commodity prices. For over 3 centuries, its identity was defined as a venue for transactional equity trading. As we can see in this interior view of the exchange, traditional market infrastructures are built around execution. In this model, revenue is tied directly to macroeconomic trading volumes, meaning income rises and falls with market sentiment. Early corporate expansion adhered to this model. The 2007 merger with Borsa Italiana broadened the company's geographic footprint, but it did not change the underlying structure of how the firm made money. Relying on transaction volumes exposes an operator to cyclical market volatility. That exposure to unpredictable revenue swings prevents a company from achieving the higher valuation multiples awarded to stable technology firms. The pivot away from that volatility occurred in 2021 with the $27 billion acquisition of the financial data provider Refinitiv. This acquisition decoupled LSEG's revenue engine from volatile, transaction-based execution fees. Today, 73% of LSEG's income is generated by recurring data subscriptions. The secondary catalyst for this transition was a 10-year strategic partnership signed with Microsoft in 2022, which committed the firm to migrating its data infrastructure to the Azure cloud. Through these 2 actions, LSEG exited the role of a standard exchange operator. It now operates as a global software-as-a-service entity, protected by the predictable economics of enterprise subscriptions. Looking at this strategy diagram, we see the LSEG Everywhere framework. This is the blueprint for integrating artificial intelligence across their product suite. The foundation of this strategy is the company's proprietary data moat. LSGC controls a repository containing over 33 petabytes of verified historical financial data. This architecture operates at extreme velocity. The system ingests up to 15 million new data points every second, continuously refreshing pricing, news, and analytics. While many traditional businesses face disruption from artificial intelligence, LSGC operates as a picks and shovels provider, supplying the raw material required for the financial AI boom. They distribute this material using the open-source Model Context Protocol. This protocol allows institutional clients to pipe LSGC's verified data directly into their own internal environments, like Microsoft Copilot or Snowflake. Large language models are useless in finance without reliable, structured, and auditable data to draw from. By controlling that data, LSEG makes itself an indispensable infrastructure layer. The business is structured around a tripartite model, integrating data and analytics, capital markets, and post-trade operations into a single ecosystem. We can map the specific power of this structure by looking at the post-trade division, focusing on the LCH clearinghouse. LCH clears over 90% of the cleared interest rate swap market globally. This level of liquidity concentration creates extreme switching costs. The market depth, combined with regulatory requirements for cleared liquidity, makes it difficult for institutional clients to move their operations elsewhere. By capturing value at every stage of the market lifecycle, from initial research to final settlement, the company builds a defensive wall against targeted fintech competitors. To maintain this infrastructure, executive management is transitioning the workforce toward a product-led operating model. This requires a restructuring of human capital. The company is moving from a 49% internal software engineer ratio to a target of 80%. This dual-axis chart shows that while engineering headcount scales up, capital intensity is designed to shrink. Management projects capital expenditures will drop to 8% of revenue by 2029. To manage the operational hazards of artificial intelligence, the board utilizes an independent model risk committee. This body governs generative AI models to prevent data hallucinations in critical financial outputs. High engineering ratios, declining capital intensity, and strict algorithmic governance are the hallmarks of a technology company optimizing for scale. The 2025 financial results show the impact of these changes. The company delivered 7.1. The market increasingly prices LSEG against data providers like Bloomberg and S&P Global rather than traditional exchanges. The current price-to-earnings ratio sits at 21.3 times. This multiple reflects an AI premium supported by tech-centric cash flow models. There are structural headwinds to this valuation. UK and EU authorities are applying regulatory scrutiny to the company's market data pricing, monitoring for potential anti-competitive behavior. Operationally, the business has taken on concentration risk. By migrating to the cloud, its architecture is now highly dependent on third-party providers, specifically Microsoft and Amazon Web Services. The survival of this premium multiple depends on management's ability to maintain its technological moat without triggering antitrust actions that could fragment the business. This summary board outlines the final institutional thesis. LSEG is an all-weather investment, largely insulated from traditional market cycles. Its 33-petabyte verified data repository ensures that the rise of machine learning models functions as an operational tailwind, driving demand for its core product. Management has signaled their confidence in this cash flow visibility by funding a £3 billion share buyback program and delivering a 15.4% increase to the dividend. The group has transitioned away from the unpredictable cycles of its marketplace past, securing a leading position in the data infrastructure that supports global markets.
My investment disclaimer. The content in this video is provided for educational and entertainment purposes only. It does not constitute financial, legal, or tax advice. The views expressed are my own and do not represent a solicitation to buy or sell any of the companies or assets discussed. Always perform your own due diligence or consult with a licensed professional before making investment decisions. Design your life, but stay safe. My